The Maryland Sole Proprietor, aka a crabby, lonesome entrepreneur. Just kidding, I wouldn't dare insult the crabs like that, but while my company tries to make their home a little cleaner, let's discuss business succession life insurance for the sole proprietor. A sole proprietorship gets taxed easily as a pass-through taxation structure, but they don't succeed very well. In fact, the IRS and most state tax departments require the sole proprietorship to die when the business owner dies. Now, this leaves the family of the deceased owner with two needs: money to replace the income that owner was bringing in because of the business, and money to replace the value of the business asset as a whole. This is where a buy-sell life insurance agreement sets up beautifully. This is a contract that finds a buyer for the business in advance. It can be a key employee, a competitor, or even another family member who wishes to actually run the business. So when the business owner does pass, this contract triggers. Death benefit is given to that buyer who then uses that money to pay for the business from the family. Now, this gives proper consideration to the family of the deceased business owner, but also it creates a ready-made market. And this is important because businesses are actually extremely difficult to sell. And sole proprietorships are even more difficult to sell because the business is often tied in with special skills of the owner. Usually the owner's actions and skills were the biggest generators of revenue. Therefore, without the owner, investors see a lack of going concern, which means effectively the business is worthless to outside investors. Now, because the sole proprietorship is a pass-through tax entity, there are no 401ks or pensions for him to retire on. All they have is the income generated and the value of the business asset itself, which again brings us back to selling. But if the sole proprietor has a buy-sell life agreement in place, there can be a stipulation in the contract saying that the buyer can use the cash value of that agreement in order to send off the existing owner into his retirement years.